Right, hello and welcome to another Expert Inside interview. My name is John Golden from SalesPOP, online sales magazine and Pipeliner CRM, joining you as usual from a sunny San Diego. Yes, it is sunny today. And I'm delighted to be joined just up the road a little bit in Costa Mesa in Orange County by Ben Mohr. How are you doing, Ben?
I'm doing great. How about you?
Yeah, fantastic. And Ben's a former institutional retirement strategist, over 20 years inside the financial system. He's seen how the wealthy build real wealth, and why most advice that we get keeps others stuck. So he helps investors make smarter alternative strategies that that break that cycle. So that's what we're going to start off with. Given your 20 years, Ben, what is the single biggest blind spot do you think, or misconception that average investors have?
I think the biggest blind spot they have, and that's where we focus, is that they really only have so much limited choice when it comes to retirement, right?
Mhm.
It's kind of the cookie cutter. I call it the cookie cutter approach. It's like either it's the market, right?
Yeah.
Everything is the market, and I'm not against the market. I mean, I definitely
Sure.
agree that people should put a decent amount of money there because when it's good, it's great. Right. But I don't think they realize that there are a lot of opportunities outside the market that they can get into. When I talk to most people, where's their money? It's mainly the market, their house, maybe an investment property, maybe they buy an annuity if anyone's familiar, just as a retirement
Mhm.
plan, and then that's it.
Yeah.
They just think they're fairly limited, and that's just not true. The ultra wealthy don't build wealth that way. They do have money in those places, but they branch out to move their money in a lot of different spaces.
Yeah, because let's face it. I mean, what you outlined there, those would be the common, wouldn't they? Pieces of advice you often get, like
Right.
put your money in the market, diversify stocks and bonds, mutual funds, whatever,
Right.
and have some real estate, etc. I mean, those are the typical. But what are some of the maybe more counterintuitive ways you should do it?
Well, one of the areas that I work in we call it the alternative investment space. Hence,
Mhm.
that's what it is. That's the traditional way to go, right? You have a 401k. I mean, almost the majority of all 401ks and things of that nature, 403bs, are in the market. And the reason that they're in the market is because the custodians, right? When a company opens, they have to have a custodian kind of handle all of that,
Mhm.
and those are going to be market based. So you really think you're limited. But when somebody goes to getting an IRA, they can go out there and get into other areas. So we deal in what we know as alternative investments. So people can
Mhm.
get what's known as a self-directed IRA. That means you go out and get a company that oversees it. We work with a company called IRA Club, but there are a lot of them out there. That allows you to invest in things from real estate, gold, gas and oil. You can buy, businesses, notes, all this stuff. The thing that we focus on in our company is we are in the alternative space and we deal with what's called life settlements, right? So it's an
Mm.
alternative. It's just a place where you can put money away and not have to deal with it being exposed to anything in the market or the economy. So that's what I tell people to look at. Even if someone chooses to not go with us, they should still look at possibly getting a self-directed IRA so they can take a portion of their money that's in an IRA, or if you just want to invest cash, that's fine too,
Mhm.
to look outside the market. Just not, you're not sitting there going, if you're sitting on $1 million IRA, yeah, it'd be nuts to take $1 million and put it in alternative investments.
Mhm.
But why not 10%? Why not 20%? So that when the market does have that one down year, you want money working somewhere else that has absolutely nothing to do with the market.
Yeah, no, absolutely. So tell me a little bit about, you said life settlements, is that it?
Yes,
Yeah.
yes. So people don't know this exists. It's been around for a while. It was actually in the early 1900s, the Supreme Court ruled that this was legal to do. And since then, private wealthy investors for about 70, 80 years kind of did this behind the scenes. What it is that you're buying out somebody's existing life insurance, right?
Mm.
So the example would be 80-year-old guy's out here. What does he need at the end of his life, right? He needs end of life care.
Yeah.
If he doesn't have a long-term care policy, which there's a huge misnomer about what those cover, they won't cover all your bills. Most long-term care policies exist for maybe 2, 3 years, and then you're still stuck with most of the bill. So where are you going to go get that money from, John? You're going to go and reverse mortgage the house. You're going to, right? You don't want to do those things.
Yep.
So if you're sitting on a permanent insurance policy, say worth $1 million, you could sell it off to somebody for $2, $3, $400,000, depending on your age, depending
Mhm.
on how bad your situation is. It sounds a little gruesome, but the issue is, we go get life expectancy reports, medical reports on this person. The less healthy they are, obviously, they're more in demand. So they're going to get a
Mhm.
higher number. Warren Buffett has been doing this for decades. A lot of the big banks have been doing this for decades. A lot of financial companies have been doing it. The reason you don't hear about it is because I tell people Warren Buffett is the smartest man on Wall Street. He's not going to go tell you that the way that he hedged any losses in a year is because 20 people dropped dead and he made X amount of money. It just doesn't,
Right.
it
Right.
doesn't
Yeah, yeah,
sound
yeah.
nice. It
Not a
doesn't sound nice.
not a good marketing message.
Yes, yes. Right. But what we always say to people is, look, we know people are going to die. That's why insurance exists, right? And
Mhm.
the reason that you have insurance on yourself or I have insurance on myself is because we're working and we, like, you and I just talked. You've got a kid in school. I've got a kid in school. You're making money. God forbid something happens to one of us on, I-5. We have that insurance so that the kids will go to school and all this. Well, if you have a permanent insurance policy and you're 80 years old, your kids are 55, 60 years old. They don't really need the protection anymore. And by the way, you're
Mhm.
probably paying $50,000 a year to keep that in force. So
Mhm.
instead, now you can kind of take the money from that, take the 300,000, you're done with it, and you go live a nice life at the end of your life. What we do then is we package that policy with a multiple policies in a portfolio, and people can come in and invest small pieces of their IRA or cash to own small pieces of all those policies, right?
Right. And then how and then that's really interesting. And then how does that translate later for them?
The insured, the person, they're
Yeah.
out of the game.
Oh, no, they're out of
They
the picture. I mean, for the
Mhm.
investor then,
Oh,
how does
investor.
the
So what happens
yeah.
is great you asked because literally right now, as before we did this, I was on the phone. We have we call it a maturity, right? It's a good euphemism. We don't like right. So I've got a group of investors that bought into this round, and we just had somebody pass, right?
Right.
So we are now right now. What happens is the person passed about a month ago or so. We have to go out and get the death certificate, prove that we own the policy, obviously, all legal,
Mhm.
and then the money comes into our trustee and now we start divvying it up between the
Gotcha.
investors, right? So if a guy had $25,000 in this, maybe he made X, the more money you have, obviously, and it's so
Sure.
forth. Like I think the largest payout we're doing on somebody in this round is about 400K. I think they had about
Mhm.
150,000 invested in this one. Somebody at 25 might have made like 60,000, but it's a $3 million payout. And the clients on this round are making roughly about 20% compounded APR on this policy.
Wow, wow.
Yeah.
And for somebody listening who might think, well, when not to be morbid, but when you're relying on people passing away, isn't it kind of random?
Yes, it will obviously that's
Yeah,
why we say in the old school way it was, "Hey John, I've got this one policy for you to invest in."
yeah.
That's so what we're getting to is what's the risk here? If the risk
Mhm.
isn't the economy, if the risk isn't that the market or political situations that we're sitting in today, right? Or, what's going on in other parts of the world, this is a product that is unaffected by those things. So what is the risk? The risk is longevity, right? The
Mhm.
longer somebody lives, the lower amount you're going to make per year.
Right.
That's why what we do is when people come in, they buy 5 policies at a time to just diversify even more, to
Gotcha.
diversify against that variance, right?
Yeah.
Is with us, the way it works, yes, it's people are like, well, what's the APR going to be? And I go, look, it's the last thing we're going to calculate because what's going to happen is, and I don't want to be morbid,
Yeah.
but as an investor, let's just look at his investment apparatus,
Mhm.
right? You're going to have some home runs, right? We've
Yeah.
had cases where somebody was expected to live 6 years and they passed away in 6 months. We're
Mhm.
talking an APR that's so out of the charts, you can't believe it. Well, I always tell those people if they own 5 policies, John, you're going to law of averages.
Yep.
If somebody died early 3 years early, what does that tell us about the final four? Somebody's going to
Yeah.
probably live a little longer. And on that one, you might make 4% or 3%.
Right, right,
So
right.
what we tell people here is continually we see clients making 8, 9, 10, 11, 12% APR. And it's not a greed factor here. Why did you invest in this? Because you wanted to diversify, portion your money away from the market, right?
Mhm. Yep.
And at the same time, you wanted to see decent returns. Because what happens is most people then go to a dinner seminar and a guy says, oh, buy an annuity. And I was one of those guys 20 years ago. With the annuity, yeah, you get the guarantee. Anytime somebody says guarantee, it means two things. They're going to lock up your money for a certain period of
Yeah.
time, and the rate of return isn't going to be very good.
Yeah.
They have to do that to know that they can guarantee you your money back. We're talking 4%, 5%, maybe,
Mhm.
right? And they can only do that because they have to take that money and invest it so they can make more, right?
Yeah. No, no, that was, thank you for that explanation. Now that makes sense. And obviously it makes sense when you package them together. So you're, spreading, as
Right.
you said, you're evening it out somewhat.
Yes, absolutely.
Some people will obviously, some may mature earlier, some may mature later, but,
Yes.
it should even itself out.
Right.
Why is it, Ben? You don't hear a lot about this. You don't hear let's face it, the media and everybody, they push all the traditional
Right.
investment that you rarely hear about in alternative investments.
Well, because everything's so Wall Street driven, right?
Mhm.
Look at the marketing campaigns that they have. Where did I see some the other day? Somebody just got busted out there, one of the big banks, and it was like, well, it's like Amazon. I think Amazon got in trouble for something, and there's like a $3 billion fine, and they don't even blink, right?
Yeah.
You remember back in the day, 6, 7 years ago, maybe 5 years ago, Wells Fargo got in big
Yeah.
trouble, right, for doing that, trying to scam everyone and having 8 things. And it was, I don't know what the fine was. Don't quote me on it, but I know it was hundreds of millions. It could have
Yeah.
been billions. And they just wrote a check. Well, what
Yeah,
does
and they're
that
still
tell you
in
about?
business.
Yeah, and they're still in business. They didn't even blink, right?
Yeah.
So what does that tell you about their marketing budget for these companies, right? I mean, it's Fidelity, it's Schwab, it's all these big players. So we're just inundated with that all the time. And the other thing is, I believe that the media is kind of, they're kind of in love with Wall Street, so
Mhm.
anything that comes out that's different, it's just like, oh, that's garbage.
Yeah.
It's a scam, right? And there are a lot of scams out there, right? That's the number one thing I get people coming and say, "Oh, it's too good to be true." And I talked to my stockbroker, and he said that this is a scam, and I just go, "Well, can you have it?" He doesn't know what I'm talking about,
Yeah.
right?
Yeah.
Just
Yeah.
as in, look, I don't deal in the stock market. If someone came to me and goes, "What do you think the net expense ratio is on?" I have no idea. It's not the
Mhm.
world I live in,
Yeah.
right? Right? It's like going to your car mechanic and having him tell you what he thinks of a motorcycle. I mean,
Yeah.
he has some idea, but he doesn't know exactly what he's talking about,
No, no,
right?
exactly. And let's face it, Ben, um, it just seems that we live in a state of permanent market volatility,
Mhm,
economic volatility,
mhm.
global political volatility. It never see every time you think we're going to get maybe a period
Yeah,
of, a little bit of not even peace, but just
yeah.
like less volatility,
Right.
something else pops up. So I feel like people, in the market, in the financial markets and stuff. I mean, the casual investor and stuff. It's a crazy roller coaster.
Right. And so what happens is where people are starting to learn now, where I believe social media is really helped is it's twofold. It's good and bad. There's a lot of scammers on the internet. I see stuff every day. It just drives me nuts where I'm like, that's a scam. I see the ads
Yeah,
for it. And it's like, look, one thing I give your people who are listening is when you see an ad, like we do social media ads like anyone else.
sure.
Our angle though is we're transparent. We say like, look, we make this claim. We'll show you. We'll show you the checks. We'll show you the accounts. We've been in business a decade. We'll show you everything we say. And I see these other people come out who are like, oh, 25% guaranteed returns per year, paid monthly, blah, blah, blah. And I have to search. I actually have to pull up their corporate documents because it will not tell me how long they've been in business. And I find out these
Mm.
companies in business less than a year. So and they're like, oh, proven track record. What,
Yeah, yeah,
10
yeah.
months? So
Yeah.
yeah, so that's the problem. That leads people to having not credibility. But what's great is on the other side is they're starting to learn about hedge funds and things like that. So if you're an accredited investor that has more than $1 million, you weren't really allowed to come to the party because a
Mhm.
lot of hedge funds are insider stuff. Like,
Sure.
yeah, you're making with the S&P 7-8%, but your neighbor over here who's knows everybody's making 12
Mhm.
because certain hedge funds, if you get in or something like us, is allows you to diversify. And so the word is slowly getting out more because people are starting to see it on their feeds, right? And start asking, there
Mm.
must be other ways to make money than just the regular way, right?
Yeah. So do you have, say in your business, I mean, do you have minimum investments? If somebody wanted to get into something like this,
Yeah.
what should they be looking at a
Well,
minimum?
we like to start that minimum small. The reason is that we believe that once people come in, they'll see it, and we understand. We don't want them to make a huge commitment,
Hmm.
right? So the minimum is $10,000 for non-qualified money, in layman's terms, is cash in the bank.
Yeah.
If you have an IRA, which is about 70% of our clients have IRA, the reason being is, there's a timeline on our product that when you come in that you might be sitting in these policies for 4 years, 5 years, 6 years,
Hmm.
8 years. IRA clients kind of like that because they're not planning on touching their IRA.
Yeah.
Like on this last payout, I'm going to guess that 2/3 of it was IRA money. Those people instantly reinvest with us because
Hmm.
they're like, well, I'm 56 or I'm 62 and I don't want to retire anyway. So that's
Yeah.
fine. Right.
Hmm.
So that's 25,000. But also I let people know, like, look, if you've got because there's setup fees that we pay for. So it's not really profitable for either of us if you do 10K,
Yeah.
for you, the investor, and for us. The other side is, though, if somebody has what I call orphan accounts and they're sitting around with an old 401k with 21,000 and change or 19, we'll go ahead and work with them. Right.
Right. Right.
Right.
Yeah, no, and absolutely. And do you see, I mean, is this the only instrument you use, or are there other ones, or is this where you just focus?
Well, yeah, this is where I have focused. Back in the day, number one, I used to be a reporter for NBC long, 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 long time ago, and then kind of stumbled into this business, finance in general. And then I always say, like, I forced gumped into this. People know what I mean. I worked in somebody's house. One of my clients, it was like, well, what do you think about this? And of course, I was like everyone else, oh, this is a scam. And then I actually took it home and did research, and I was like, wow, this is an interesting product. And it's funny, John, I used to do a lot of dinner seminars, still do them occasionally. And I decided just to put 2 slides in my entire dinner seminar just on this to test the waters. And it caught on like wildfire. Right.
Right.
People are like,
Yeah.
whoa. I will say this, when people meet us on this, they're never like, oh, what a terrible product. They may not invest, but they're like, wow, that's interesting. Everyone's always
Mm.
fascinated by it because they're just like, I never knew that existed.
Yeah,
Right.
yeah. No, no, me neither. And it is fascinating. And part of it is too, though, is that and people need to go through a bit of a mind shift change, don't they? Because
Yeah.
I mean, I'll say I came to the US during the dot-com era. Like I came over from Ireland
Yeah.
in the mid late 90s, and to be honest, back home, like, I mean, people might have had a share certificate for a few shares in some
Yeah.
massive company, and it's sitting in
Yeah.
their closet or whatever. But there wasn't a real investment culture. And then coming obviously during the dot-com, suddenly
Yeah.
it was, oh, this is like gambling. Like I
It
can
is.
buy shares in this
Yeah.
company this
Huh.
week, and it'll have gone up 200% by next week. Life
Right.
is great. And I feel like sometimes people haven't, even we've gone through all these corrections, people have still not got out of that mindset of,
Right.
being able to stare at their thing going up and
Yes.
down all the time.
Right. Well, and that's the thing, because I have a lot of people who are like, "Oh, well, where can I go on here and look at my account daily?" And I
Right.
kinda go, "Well, what do you wanna know? What do you wanna know? That Mrs. Jones ate a muffin this
Yeah,
morning? I don't know
yeah,
what you want." I mean,
yeah, yeah.
it is a different thing. It's like, "Look, guys, we do give updates to people on the cases
Sure.
on an annual basis." They wanna know
Mhm.
that, like, where are we at with this? But we don't have something where you can click in there and then see what they are every day, you know? That's getting over a little too morbid, right? It's like,
Mhm.
we'll let you know, but yeah, it works that way of like, look, you already know what's cool about it is you know what you invested and you know what your end game is, right?
Right.
If you came in today and said, hey, here's money, I'll give you an example. Hey, I've got on one policy, let's say you had $25,000 and you're going to get paid $50,000 on that one policy.
Mhm.
The only thing we need to know is timeline. I
Right.
know you gave me the money today on the 6th or whatever it is
Sure.
of this date. Well, now it's 4 or 5 years later. And that's like, we just got this payout. So today, because we know we're going to pay everybody, we could break down their interest rates down to, 1/100%, because now we know we're going to give them the
Mhm.
money. Right. And that's
Yeah.
where people have to look. They're just constantly looking, what am I making every year? Our angle is, it's like a reverse mathematics, right? We know what you're getting at the end. We know what you gave. Now it's just timeline. How fast can we get that money back to you?
Yeah, probably healthier from a mental health perspective too.
Yeah.
If you're not like, if you're not just going up and down on all these like
Right.
volatile roller coasters
Right.
all the time, and but it does. I mean, I do think it does require people to reset a little bit and
Right.
realize that you have to be patient as well in things like
Well,
this. And mostly those things are, I mean, mostly the best things are you have to have a little patience.
right. Well, what's cool with what we have is that most people put in 5, 10% of their net worth. So if I'm sitting down with a guy who's got $1 million or a gal who's
Mhm,
got $1 million, they're putting in 50 to test it out. They might
mhm,
put 100. Imagine it, it's 5% of your overall net worth, right? So we don't get too much hassle on people like, how's it going? How's it going? Because
mhm,
it's just a little bit of their money that they're putting over here saying, you know what? Like I've got too much money over in the market or here. So that's the goal. Like if anybody works with us, we really want to keep that like in a 10% range, right? Because of
right.
the reason, and was where we're very honest, is like, look, it's illiquid. You can't
Mhm,
come back to me and say
yeah,
you're going on a cruise to the Bahamas in 2 years. That
yeah,
money, you and other people were dedicated to buying this policy, and now we just have to sit and wait.
yeah,
Right. So,
mhm,
and by the way, that 50,000 is now split up over 5 policies. So you're only
yeah.
committed to like 10,000 each policy, makes it more of a calm situation for people. Right.
Yeah. Yeah, no, it's super interesting. Thank you so much for sharing this with
Yes.
us, Ben. It's great education for me as well. I got to note this down in my notebook here for
Yeah.
potentials for the future. All of Ben's information will be below this video. But before we go, please do remind people about what you do and how they can get in contact with you.
Yeah. Again, the company that we work with is called Life Asset. It's just singular, lifeassetllc.com, lifeassetllc.com. And when they click on there, they'll see a link tree on there. Click on that. It's got every information. We are fully transparent as far as we have ebooks, brochure, everything you'd ever want to know on this. And of course, then there's a book a time with us, and they will, if they book a time, they will talk to me. There's not some person over in the Philippines or India that's answering the phone. We are direct. We aren't some huge company. This is a
Mhm.
very niche industry. Everybody knows each other. So it's not like they go, it's not like we've got 100 sales guys sitting around. We do
Gotcha.
about $10 million worth of sales a year, right? And
Mhm.
by the way, it might sound small. That's actually pretty decent sized for this industry, right? So you're going to
Yeah.
small core of people who know this product because that's what you need. You need, there's not a lot of us out there. So this is what we've dedicated our lives to.
Yeah, so I recommend people go check it out, particularly if you're tired of the volatility in the markets. Maybe you're not getting the returns you want. Maybe you want to think about something different. So go check it out. As I said, all the details will be below the video. So thanks again, Ben. Thank
Okay.
you for watching and listening. And I will see you all again very soon.